Welcome to the Bogart Effect, a wealthy wisdom podcast. The following Bogart Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Please see important disclosure information at the end of the presentation. Good afternoon, this is James Bogart. I've got Nick with me today, and we're going to be talking a little bit about, I've got $10,000 burning a hole in my pocket, and what do I do with it? So the design is to talk about really Gen Z is younger, fresh out of school, you're working, you've now got some savings building up.
Where does it go?
Like, what should I do? So what should you do?
So where I like to start, James, is kind of educating them.
Okay.
Where are the places it could go? A lot of people know about their basic savings account, checking account. That's what they have at the bank. They kind of understand those generally. But there's a lot of other tools that you can use to kind of help that money work for you better.
But why, right? So I'm a big believer that you got to understand the goal. Like, what is the goal, and kind of work backwards from there. And I think when you're at your age, literally everything is chipping away at the exact same dollar, right?
Yeah.
So yeah, you're finally at a place where it continues to grow. The checking account's starting to accumulate a little bit more. I've got a savings account, et cetera. But all of a sudden, it's like, well, where's this money going to go? Begin with the end in mind, understand the goal. And this is where, especially as we go through that transition phase in life, right? It's, you're saving for houses, you're saving for cars, you're saving for kids, marriage, you name it, everything's coming after the same dollar.
Absolutely.
Right. So one of the pieces of advice I always give is you have to have a plan. Like, I agree completely. You got to educate them, but part of that educational process is have a plan.
Absolutely.
Right. And so with doing it, you're building out plans right now, right? So talk about some of the things that someone would want to allocate money towards.
Yeah. So I think you framed it perfectly. There's a big plan. There's long-term goals you have to think about, more intermediate term. There's even short-term. That's kind of what people think about most, but there's all those different time frames that are really important to think about.
So what's the first one?
Short-term goals.
Perfect.
Biggest thing, in my opinion, that is important now is what we call an emergency fund.
Okay.
So it's having money sitting to the side that is liquid, so easy to access, and it's there for maybe your car breaks down. I need a little bit of cash. I spent all my paycheck. I need to get it now. You have that, maybe.
Well, how much should you put in something like that?
So it's typically recommended, kind of industry-wide, is the number. It's 3 to 6 months of daily living expenses.
And, I want to pull on that one a little bit more, only because I think job functions differ. And I say that simply because income can be a lot more volatile for certain jobs than others. Not to pick on them, but let's use realtors as an example, right? Like, that's a commission sales-based job. They don't have big base salaries, right? So they're not living typically off their big base salaries. They need sales. And that's one where, you could have a fantastic month that could feed your entire year, or you could literally have nothing for 12 months and then all of a sudden have something come in. In that example where it's a sales role, where you have a lot more variability of income, I tend to like to expand that emergency bucket.
Based around stability.
Yeah, basically. Well, and in some ways you've got a buffer in place to be able to use for the inevitable. I mean, some cases just pure living, but then the inevitable surprises. But for those that have stability, they've got a good salary, might be a bonus, whatever, they're not having the huge variation in their comp. Yeah, you could probably talk about that.
Right,
So within the emergency fund bucket, what are the appropriate, you don't want it in the checking account, right?
No, I mean, that's kind of what most people see it as, but if you don't need that money right away, if you don't have those emergencies, it's not working for you at all.
Well, and that's where I'm going with this, right? It's like money market conduits. And there's a huge difference between like a CD, a money market, a high yield savings account. I'm a believer. I want my money working for me as best possible. Like, I look at what we're doing with the Schwab money market programs now at 5.2%, and I can get that money in a day.
Yeah.
I mean, that's where I'm parking all my emergency stuff or upcoming bills, things that I'm saving for. like I prefer that over, say, for example, a short-term CD because I don't know when I'm going to have something coming in and I want the liquidity and I'm not getting enough of a return enhancement to go into a CD in this current environment.
Yeah.
And then I compared it, for example, I use Wells Fargo, but in my savings account at Wells Fargo, I'm only getting 3%. Well, 5.2 is better than 3, right?
Absolutely.
So, and all I have to do is journal money. I mean, that administrative burden is such that I'm okay with moving the money over. And oh, by the way, it's out of the checking account, out of that. So like it's less line of sight to it. I know I can get it quickly, but it's not right there with that temptation to spend.
Exactly.
So again, we talked about emergency funds. I think it's important, 3, 6, depending upon variable of income, maybe even longer. Everyone's a little different in that regards. I'll tell you, I'm in a very variable income role, right? And I was my entire career. It's been basically sales. And yeah, I carry about 6 to 12 months in a emergency fund. But in my checking account, I only keep 1 month of expenses, right? I don't want dead money in the checking account. But everything else goes into that 6 to 12 month. It's there. I've got line of sight. Yeah. I will admit, when money market yields were bad, that was hard. That was really, really hard to do because you weren't getting any type of income off of your money. Yeah. And it's like, well, why not just go spend it? Or, I mean, throw it in the market, but then you got amplitudes. So talking about emergency fund, that's the short-term bucket. What's next? So
more of a medium-term bucket would be, it kind of depends on your age, obviously, but maybe you want to buy a car or buy a house. Something like that you're not going to do in the next 5 years. It's more medium-term goal. Yep. So you need this money to work for you. Little overtime almost.
We should have it, right? Yeah. So in that type of conduit, now we're talking about probably a brokerage account.
Absolutely.
Right? And you probably want to have it invested in something, right? Usually we do something like a moderate risk strategy for that type of money. Love mutual funds, love ETFs, keep the costs low, but just kind of set it up and let it go. Now, what's the long-term bucket then? Let's talk about what are some long-term goals?
Yeah, so long-term goals, the biggest long-term goal is retirement.
Yep.
Once you retire, you don't have that stable income. You'll get Social Security eventually, but
maybe.
Yeah, let's hope.
Yeah.
That's my hope. But you need this money to live off of.
Sure.
So you need it to be there, and there's a lot of things to consider. Some people my age might not have heard of RMDs. If you have really high money in taxable accounts or pre-tax accounts, appreciate it, you're going to have to pay a ton in taxes. So that's a consideration that you can work towards now to decrease those risks in the future.
Well, and this is where I frame it with goals because it's important to understand the alignment, right? Once you have the goals aligned with what the strategy is, then it's talking about what's the types of accounts that we should be using for that. And so like we talked about short-term money markets, that's perfect. We talked about intermediate, going into like a brokerage account. Yeah. But then the long-term stuff, let's take advantage of the tax environment and let's structure it in a manner where it's going to work for you. And so within the long-term types of accounts, you've got probably 401ks or some type of retirement plan with work. And then you can do an IRA or a Roth IRA outside of those plans. My general guidance always is, if you have excess savings, let's max out whatever matching benefit you're going to get from your employer, right? So if you're in a situation where they're going to match the first, let's just say 5% of your income, and they'll give you whatever it is, right? Even if it's 50% or 100% of whatever you put in, that's no brainer. That's free money.
It is.
Well, you'd be amazed, right? I'm amazed at how few of our employees, the younger employees, aren't participating at Bogart Wells. I can't say anything because I'm their boss, but it's like,
come on,
guys, and on the flip side, I will say I'm amazed at how many, some of them are doing a lot of savings, right? But when you're in that younger age, getting that saving component going as early as possible, it's so invaluable. But this is where this alignment conversation is so important because you want to save in the right place. So max out the free money, right? And then from there, it's all right, what's the best vehicle after that? I'm going to typically say if you believe you're going to have upward mobility in your income, I love using Roth money now when you're in relatively lower income years.
Lowest you hope to be.
Well, because at the end of the day, it's a math equation, right? Because when it's growing, and by the way, just real quick, a Roth IRA, money is growing completely tax-free. And as long as you're 59 and a half and that Roth's been in existence for over 5 years, all the money comes out tax-free. Whereas with a traditional IRA or a 401k, all of that money is growing on a before tax basis, tax deferred. When you take it out, you pay ordinary income. I think there's appropriateness for all of the different account types. So we talked about IRAs, 401ks, we talked about Roth, we talked about brokerage accounts. You really need to have, in my opinion, all of them. And this is why we talk about this prioritization of goals and understand that everything's kind of chipping away at the same dollars. But recognizing each of us respectively has to assign that prioritization, right? And one of the basic things that I always talk about from an educational perspective is just this time value of money concept. The earlier you get money invested, the better off you're going to be longer term. We ran this exercise recently for a child of one of our clients, but it was just by maxing out a Roth IRA starting at the age of 20, which, by the way, max you can contribute to a Roth is $7,000 a year. But just by starting at the age of 20 and all the way up until the age of 59 and a half, it was $1.67 million at the age of 59 and a half, right? So that was essentially, let's just call it 40 years worth of contributions at 7,000, that's 280 grand. But that grew because of all of that time. This is assuming an 8% rate of return, right? Now, the conversation, if they waited until 30 to start doing this, all of a sudden it's now about 970,000. So
significant difference.
Huge difference. 10 years of putting it in and having it invested versus waiting that 10 years and what ultimately happens. That's why when we come back to this conversation of I'm fresh out of school, I'm starting to save money, well, we need to have that money working for you because the earlier you can get it invested and growing and savings, so much more impact in future years, right? And it gets so much bigger. All right, so what next?
So once you have the idea of where you want it to go, you kind of need to look at yourself, like, what are you willing to do? So you need to think about your risk tolerance. You need to think, okay, obviously there's some things that are much more risky than others. You can go individual stocks and bonds, which are mid to higher risk. And then there's mutual funds and ETFs, which are an aggregate of stocks and bonds together. So it allows you to basically set up this diversification, but that's where the risk tolerance comes in, kind of figuring out what you're comfortable with.
I talk about alignment a lot, right? Like, let's align with the risk. You know, putting everything in Tesla stock, well, that's one stock with a lot of volatility. Not saying it's bad stock, let's be clear. But that's one stock, so you can expect a lot more amplitude with it. Whereas if you go into something like the S&P 500 index fund, where there's very low cost structure ways of doing that. Well, now you've got 500 stocks, you know, one position, 500 stocks. You know, and this is where I think, especially when you're talking about wealth accumulation, you really want to just constantly be consistently saving, we call it dollar cost averaging, into these respective buckets. Make sure that the risk is aligned with what the goal is, right? It's exactly what you're saying. Now, we're biased, but I love ETFs, right? I think ETFs or the exchange traded funds are a very low cost way of getting the diversification, especially when you don't have boatloads of money that you can get really risky with portions of that money, right? So it's the tried and true, more stable way of seeing wealth grow and accumulate year over year over year. But at the end of the day, it's all about saving, right? Real wealth is created by saving and spending less than what you have. You know, and so I think related to generationally and what's helped me just build savings and wealth has been really mindful of, as my income grows, paying myself first, right? And it's kind of a gimmicky saying, but there's a lot of truth to it, right? So instead of increasing my standard of living, I increased my 401k contributions, or I increased what I was saving respectively along the way.
Keep the standard of living stable.
To keep my standard. Now, I'm not going to say it didn't elevate, because it did, but not at the same pace that the income was, right? So it's more of that's stable. Now, I'm also a big believer, and we've said it multiple times, get your assets working for you, right? Get to a place where, you know, ultimately you're making more in the market than what you're making, and that's when real wealth gets created. Now, of course, that takes years to do, but as you build that wealth and it continues to grow and it continues to compound, being diversified, having a plan, having it aligned with the respective goals, that's where real wealth gets created.
Well, as you said, it takes a long time to build, but there's no better time to start than now.
Wow, I mean, you got to start somewhere. Nick, thanks so much for the time today. Looking forward to having you back. Thank you.
Awesome.
The previous podcast was intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Different types of investments involve varying degrees of risk, and it should not be assumed that the future performance of any specific investment, strategy, or service will be profitable, suitable, or successful. Bogart is not a law firm or accounting firm, and no portion of its services should be construed as legal or accounting advice. There is no guarantee a client will experience a certain level of results if Bogart is engaged. Our brochure describing services and fees can be found at www.bogartwealth.com.